Good morning. This is Professor Marsh, and this is Principles of Financial Accounting, Chapter 3, Unit 3, Analyzing and Recording Transactions at Newberry College, Accounting 210-0 in the spring of 2022. You are going to learn in Chapter 3 the nuts and bolts of accounting. You will learn the skills of double entry bookkeeping, a skill that will allow you to earn a living for the rest of your life. It's very, very important that you learn this chapter well. If you need to read it twice or even 3 times, that's fine. You won't hurt yourself. It's a short chapter, but it has a lot of meaty information, and it teaches you step by step with good examples how to prepare all of the types of documents and entries that you need for all the rest of accounting to work out. So it is very important that you learn this well. Let's move on to the learning objectives for the chapter. There are 6 learning objectives for this unit, and the first 2 are going to be very, very full of important information and some tools and techniques that you're going to need to learn in terms of analyzing transactions and classifying them, and then how to record them. So we're going to spend at least 1 lecture on the first 2 objectives, and then we'll do the last 4, and the last 4 are full of exercises and examples that you can follow as you do your homework, as you do the exercises or answer the questions on the quiz. So it's really important that you learn this information. This is going to be the foundation of everything else we do this semester in this course and everything else you'll ever do with bookkeeping or accounting for the rest of your lives. Okay, the learning objectives, there's 6 of them. The first one is to describe the principles, assumptions, and concepts of accounting and their relationship to the financial statements. And so principles are going to be sort of the theory of accounting, and there are several principles that make up the accounting rules. And so whenever you have a question as to how to record a transaction, how to account for something, these principles are typically what we are going to follow in terms of reaching the correct answer. And then we're going to define and describe the expanded accounting equation and its relationship to analyzing transactions. So remember the accounting equation from the previous chapter, which is assets equals liabilities plus owner's equity, which is sometimes called stockholders' equity when we're talking about corporations. And most of the examples we'll do will be for corporations. That's kind of old-fashioned because nowadays most businesses are set up as LLCs, but we're still going to do it that way to learn it, and then we'll learn how to do the specific techniques for the other types of entities as we get further into the chapter. So those are the first 2 objectives. So remember, we're going to expand that formula, assets equal liabilities plus owner's equity. We can expand assets into current assets and long-term assets. We can expand liabilities into short-term and long-term liabilities, and we can also expand owner's equity. And expanding owner's equity is what we're going to talk about first, because the owner's equity is the section of the balance sheet that incorporates what's happening on the income statement, and it'll show you how those statements fit together. Okay, then when we get to the next lecture, after this one, we're going to do the last 4 learning objectives, which, just to give you a preview of what's coming, we're going to define and describe the initial steps in the accounting cycle. So there are specific steps that we take. There's actually essentially 10 steps to the accounting cycle, and we're going to talk about the first 4 in this chapter. Then we're going to analyze business transactions using the accounting equation and show the impact of the business transactions on the various financial statements. Then we're going to use journal entries to record transactions and post those transactions to T accounts, and we'll talk about what that is next time. And then we'll prepare a trial balance. Now, those learning objectives, those will teach you the basics of double entry bookkeeping. I mean, we're going to have additional chapters on adjusting entries and then closing entries and actually preparing the financial statements. Those are going to come in units 4, 5, and 6. So in unit 4, we will look at adjustments. In unit 5, we will look at closing entries. And in unit 6, we'll go back to chapter 2, especially section 2.3, and we'll use what we've learned in these chapters to actually prepare financial statements. So, okay. The opening summary of the chapter, Why It Matters, introduces us to our hypothetical client, Mark Summers, who was starting a dry cleaning business instead of a burger joint, I guess with the name Summers. But Mark is going to have a dry cleaners that he's going to call Supreme Cleaners. And so that'll be our example for this part of the material. Before we get to the simpler example of Mark Summers and Supreme Cleaners, though, let's look at a little accounting theory and regulations that relate to learning objective number 1 for the chapter. So we're going to describe the principles, the assumptions, and the concepts of accounting and their relationship to the financial statements. Remember, back in chapter 2, we talked about the Financial Accounting Standards Board, or FASB, which is an independent nonprofit organization that sets the standards for financial accounting and reporting standards for both public and private sector businesses in the U.S., including GAAP, the Generally Accepted Accounting Principles. Those come from FASB. And GAAP are the concepts, standards, and rules that guide the preparation and presentation of financial statements. The Securities and Exchange Commission is an independent federal agency that's charged with protecting the interest of investors, regulating the stock markets, and ensuring that companies adhere to GAAP requirements. And it does it by requiring that companies that offer their securities to the public report certain financial information on a periodic basis with the Securities and Exchange Commission. And they also have an enforcement section that investigates and sometimes prosecutes or fines people who don't comply or who do things incorrectly, or even worse than that. The FASB uses a conceptual framework, which is a set of concepts that guide financial reporting. Note that there's an ethics blurb in your materials, the importance of auditor independence. Auditors are supposed to be independent. Note that there's also some information about GAAP versus the International Financial Reporting Standards. The International Financial Reporting Standards are used in over 120 countries around the world, but not in the United States. GAAP and the International Financial Reporting Standards are very similar, but they are not identical. And so if you are looking at a foreign company's financial statements that have been prepared under IFRS, you have to analyze the differences to make them comparable to GAAP. And some of those differences can be important in the way that they recognize revenue, the way they handle leases and other financing transactions. So just keep that in mind. But I know this is all new to you. Note that the small beginning companies like Matt Summers and his dry cleaning business don't need to worry too much about the FASB and the SEC, and definitely don't need to worry about the International Accounting Standards Bureau and the International Foreign Reporting Standards. They just need to worry about bookkeeping and getting their financials correct. So they're going to learn good basic nuts and bolts accounting. And we're going to look at these foundational principles, the assumptions and concepts, but understand that a lot of small businesses just basically need to get their books set up and get them set up correctly. Okay, so the revenue, some of these principles, assumptions, and concepts. Okay, one is going to be the revenue recognition principle. That requires companies to record revenue when it is earned. Now, revenue is earned when a product or service has been provided. However, revenue is recognized, it can be recognized under different methods of accounting. So you can have a company which is on the cash method that only records revenue when cash is received, similar to a lot of service businesses like our law firm, many accounting firms that are smaller accounting firms. Many service businesses operate on the cash method. Many retailers do. I would be willing to bet that Summers Burgers down the street from the college probably operates on the cash method. Bigger businesses and more sophisticated businesses, particularly ones that have substantial debt relationships with either institutions or banks, other banks, will have accrual accounting. And so the revenue recognition principle for accrual accounting oftentimes will record the revenue when the service or the product has been provided to the customer, whether or not the customer has paid yet. So anyhow, revenue recognition principle. The expense recognition principle requires that expenses incurred match with revenue earned in the same period. The expenses are associated with revenue generation. So in a cash business, if you had let's say a dry cleaning business, and you knew that you were going to eventually have a machine that could operate for 3,000 garments, and so you bought 3,000 hangers to use on your garment machine that you punch in the number and it brings around the customer's numbered garments on the bag. So if you've got 3,000 hangers, but the first month that you're in business, you only have 100 customers and only use 200 hangers. Well, in a cash business, you would immediately expense all of those hangers. In an accrual business, and using the expense recognition principle, you would probably capitalize that investment and then perhaps use those hangers as the customers walk off with the clothes, and then periodically replace your supply of hangers, but you would probably match the hangers expense as a cost of providing the dry cleaning business. And so you would try to match those expenses. Let's say you charge $10 to clean a garment and the hanger costs you 25 cents. So every time you sent off a garment and got your $10 fee, then you would take also a matched expense deduction for the 25 cents of the hanger. That's kind of what we're talking about here. The cost principle records assets at their value at the date of acquisition. Okay, so we had revenue recognition principle, expense principle. Now we're talking about the cost principle. So it records assets at their value at the date of acquisition. Now this is very important in an economy that has a lot of inflation, as we're getting into over the last year or so. A company may not record what it estimates or thinks the value of the asset is, only what is verifiable. And what's verifiable is the price at which it was acquired or the costs at which it was constructed. So this verification is typically represented by an actual transaction, by the actual purchase receipts and the costs for the various components that go into a product that's manufactured, or the actual costs at which something was purchased at wholesale to be resold at retail. So that could be very different than the price they are today, because if you had been accumulating things, let's suppose you were selling decorative items and you had these gift boxes like Tiffany's. They have the little blue box that people like to get presents in, particularly jewelry. And let's say you purchased those little blue boxes back in 2010, 2015, 2020, and over time, they cost you a couple bucks back in 2010, and then maybe a couple bucks more in 2015, and even more in 2020 or 21 as inflation kicked in a little higher. And as you held those boxes in your inventory to be used to box up the items that you deliver to your customers, you're going to have differing prices. And one of the things that we're going to learn when we study inventory methods is how we assign which box at which price to the sale that you're making today to the customer who may have gotten a box from 2010 or 2020 or 21, and how are you going to assign that. But the cost principle says you can't write up the value of the inventory to the current cost of buying a new box. You have to use historical costs. Okay, so that's an important principle. So we're going to use historical costs based on actual transactions. There are some exceptions to that, but we'll talk about that when we come to adjusting entries. And change of accounting methods, which may be a topic for another course. The full disclosure principle requires companies to relay any information to the public that may affect financials that are not readily available on the financial statements. This helps users of information make decisions that are more informed. So, full disclosure principle is something that was violated in the Enron scandal. Enron was setting up these special purpose entities to hide a bunch of liabilities off the balance sheet, and those were not disclosed to the public, even though those were claims against Enron's assets and drags on their earnings. None of that was disclosed until Enron kind of blew up. The separate entity concept maintains that only business activities and not the owner's personal financials may be reported on company financial statements. So that's also a very important principle, that only the activities of the business itself, not the owner's other activities, are reported on the company financial statements. And a lot of times we'll get into issues with that in practice when we see closely held businesses that have been managed as basically a family enterprise for a long period of time. I've certainly run into clients who had airplanes and yachts and lots of family vehicles on the balance sheets of their companies, and a lot of the expenses of those assets, which may have been business but may have been personal or may have had some elements of both, reported fully on the company financials. And the IRS oftentimes will come in and look for those sorts of expenses and disallow those as business expenses, saying that they are more personal than business. So that's also a topic for another time. The levels of authority and the principles, concepts, and assumptions are presented in Figure 3.2. And let me just turn to that for a second. So if you'll look at Figure 3.2, you can see a schematic that shows. This is the one that has the SEC up at the top that enforces GAAP, the FASB that sets GAAP, and then generally accepted accounting standards. And of course, most private companies, certainly Mark Summers and Supreme Cleaners, is not going to have to worry about the SEC or really even FASB, but they are, if they're preparing accurate financial statements, are going to want to follow the generally accepted accounting standards as promulgated by FASB with all of these principles. So you can see under generally accepted accounting standards, you can see these 9 principles and also assumptions and concepts that make up the theory behind the rules that we have in accounting. So you'll see the revenue recognition principle that we've talked about, the expense recognition principle, the cost principle, the full disclosure principle, and the separate entity concept. And there are some more as well, and let's go on to those. So conservatism prescribes that a company should only record expenses or losses when there is an expectation of their existence, but only recognize gains or revenues when there is assurance that the revenue or gains will be realized. So conservatism says, let's not, if we're going to have a bias against overstating income, we don't want to provide too rosy a picture to the users of our financial statements, and that is certainly a long-standing convention in accountants. It doesn't mean that accountants are necessarily conservative. There are plenty of accountants who were Democrats or Bernie Bros and that sort of thing. I'm sure that the big 4 accounting firms make as many contributions to the Democrats as they do to the Republicans. It's not that type of conservatism that we're talking about. We're actually talking about conservatism as a bias to not overstating our income. We don't want to provide too rosy a picture to the users of our financial statements if we can't be assured that income is going to be realized. And we should definitely record expenses or losses as soon as we expect that those expenses or losses are going to occur. Okay, monetary measurement requires that a monetary unit be used to report financial information such as the US dollar. This will make information comparable. Now, obviously, there are many fluctuations among different types of monetary units. As you probably know, the dollar sometimes is worth, more in euros or in Chinese yuan or Japanese yen or Swiss francs or Bitcoin or Ethereum as time goes by. So when there's inflation in the United States, the value of the dollar tends to decline versus other currencies that are not experiencing that type of inflation. And when the dollar is stronger and inflation is low, then it tends to be worth more in those other international currencies. But you have to have some unit of measurement in money in your financial statements. The going concern assumption is a very important assumption, and it's one that has played into a number of the scandals that have involved accounting firms and SEC work and that sort of thing. So the going concern assumption assumes a business will continue to operate into the foreseeable future. And if there's any concern on the part of the auditors that the business will not continue operating, the auditors first need to disclose this to management and to other users of the financial statement and say, hey, it's like a cancer diagnosis. You've got a problem and it may be terminal. And so this is something, there's actually an exception to the typical opinion that's provided by auditors and audited financial statements with respect to going concern. And if you get a going concern exception in your audit and in your financial statements, your share price is going to take quite a beating. So in any event, that's usually just really the darkest of dark clouds on the horizon for a business that is in serious trouble. Going concern exception, and the going concern assumption is that we're going to keep operating the business, and that's an assumption that's typically made in financial accounting. Then there's a time period assumption that presents financial information in equal and short time frames, such as a month, a quarter, or a year. For our income statement and our statement of changes in owner's equity, we're going to have and a statement of cash flows, we're going to have a period of time that we will have as the parameters for the financial statement. So we'll typically have that assumption as well. And then the accounting equation shows that assets must equal the sum of liabilities plus equity. And transactions are analyzed with this equation to prepare for the next step in the accounting cycle. Now, note that in your materials there was discussion of the 2017 Tax Cut and Jobs Act. That was the tax bill in the Trump administration. And that was a big cut in corporate tax rates from a maximum of 38% that existed back in 2016 down to 21%. So a cut in the maximum tax rate of almost half. And this was designed by Congress and promoted by the administration to try to make U.S. companies stay in the United States and operate, and to make the maximum tax rate that's paid by corporations in the United States more comparable to the lower rates that existed at that time in many of the other developed countries, even if they weren't quite as low as the tax rates, sometimes zero, that you'll find in some of the tax shelter havens in the developing world. But that was a big cut in the corporate tax rate. And corporations have to estimate their deferred taxes as a liability. So if corporations, say, have recognized financial income that's in excess of their taxable income in a period, they have to calculate what the tax would have been had they, paid the tax on the accounting income, and the difference between the tax they actually paid on their taxable income. So let's say that a company can recognize $1 million in income for accounting purposes under GAAP, but because of certain tax breaks and deferral techniques, it only has to recognize $500,000 in income under the tax rules, under the rules of the Internal Revenue Code. So that $500,000 difference back in 2016 would have had a 38% tax rate. So 38% of $500,000 is $190,000 in tax that is deferred. In other words, the corporation would have to set up a liability on their books that says, hey, in the future we expect we're going to have to pay this $190,000 in tax. Now, when the tax rates were lowered down to a maximum of 21%, when that $500,000 is actually recognized, let's say it's recognized in the next year, in 2017, after the tax cut, the tax rate on that is only 21%. And so the tax, 21% of $500,000 is $105,000. So that's a whole lot less, isn't it? And so, at that point, you've got a difference between the $190,000 liability you'd been carrying under the old tax rates and $105,000 that you now expect you're going to actually pay. Well, that $85,000 difference can be booked as income because of the change in the tax rates because of the lowering of the tax rates. Now that's a pretty huge amount. I mean, if you're talking about a business that was expecting to have $1 million in income in a year, and they get a $85,000 tax cut. I mean, that's what's that, 8.5% of their income. That's huge. I mean, that's a really good year to have an 8.5% growth in your income, and just from one tax bill. And so what happened in 2017 is that these companies, because of this tax cut, were able to recognize a huge amount of income for this extraordinary event of the big decrease in taxes, and it was a huge boost to the stock market, and I think we're still seeing the effects of it. The proposals to increase the tax rates back up to 28%, and in some cases higher, failed last December because they weren't able to pass the Biden administration proposals. Okay, double entry bookkeeping. This is the basic components of double entry bookkeeping are accounts and a general ledger. Now, an account is a record showing increases and decreases to assets, liabilities, and equity. Okay, assets, liabilities, or equity. And a general ledger is a comprehensive listing of all of a company's accounts with their balances. Okay, so those are two very important concepts that you will have to learn. Now, double entry accounting bookkeeping means that every time we record a transaction in the double entry bookkeeping, we must record the transaction in two different accounts, and one will be a debit, and those would increase assets or decrease liabilities or equity. And then there'll be an offsetting entry, a credit, and the credit would be a decrease in assets or an increase in liabilities or equity. The debits always have to equal the credits in accounting. That's a basic check and balance that's built in to the double entry financial accounting system. Okay, so debits and credits are recorded in T accounts, and you can see in section 3.1 there is a picture of a T account toward the end of the section. You can see that under the debits and credits header, and we're going to look at T accounts a lot in this chapter. And then you can see how the accounting equation, the assets equals liabilities plus equity, or whether you call it owner's equity, stockholder's equity. So assets equals liabilities plus equity. That's expanded for you also just below that T account, so that you can see each one of those categories as a T account. Okay, so assets, under assets there'll be debits and credits, and the debits will increase the assets, the credits will decrease the assets. Then under liabilities there'll be debits and credits, the debits will decrease the liabilities, or the credits will increase the liabilities. And then you'll see all the equity accounts, and for all the equity accounts you've got debits and credits as well. And if their normal balance is a positive number, then the debits will decrease them and the credits will increase them. And if their normal balances are negative, then the debits will increase them and the credits will decrease them. And you'll see all that. So that's what we're looking at there. So, and I know I said negative number, but what I really meant is if their normal balance is a credit in the equity accounts, then credits increase and debits decrease. And if their normal balance is a debit, like dividends or expenses, then the debits will increase them and the credits will decrease them. Okay, and then we see the normal balances, and you can see which of the items in the expanded accounting equation typically have debit balances, and they increase with debits, and then ones that decrease with either debits or credits. So there's that. Okay, so that's it for section 3.1. And also, before we move on to that, note the concept of an abnormal balance and the example where your client overpaid an invoice, and so your accounts receivable. Well, your client overpaid an invoice, and so the accounts payable for your client, if you're the auditor for that client, is going to have a debit balance instead of a credit balance. Typically, accounts payable are liabilities, typically short-term liabilities, and the normal balance is to be a credit balance because a liability normal balance is a credit. But if you overpaid an invoice, if you paid more than you were actually billed, then really what you've done is you've created a receivable back from that client, but it's typically recorded as a negative balance in account payable, so it would be a debit balance, but on the liability side. Okay. Section 3.2, define and describe the expanded accounting equation and its relationship to analyzing transactions. So the expanded accounting equation breaks down the equity portion of the accounting equation into more detail to show common stock, dividends, revenue, and expenses generally. And individually, sorry. And the chart of accounts is a numbering system that lists all of a company's accounts in the order on which they appear on the financial statement, beginning with the balance sheet accounts and then the income statement accounts. And you can see the expanded accounting equation in figure 3.3 that illustrates it. So you can see how equity breaks up into contributed capital plus retained earnings, and contributed capital is common stock, and then under retained earnings are a negative account for dividends, payments back to owners, and then a positive account for revenues and a negative for expenses. So revenues minus expenses equal net income. Remember that from chapter 2. So that's part of retained earnings, and then dividends, of course, are the earnings you don't retain, so that decreases retained earnings. So that is the expanded accounting equation. Note the chart of accounts information and the way that accounts are typically numbered. Assets typically start with a 1. Typically cash is 100 or 101. And you can see you typically have 3-digit numbers for a small company, maybe 4-digit numbers for a large company. Companies that have lots and lots of divisions and that consolidate a lot of different operations oftentimes will have extensions after the numbers. If every division has its own bank account, then the 101 account for cash might have 0.1 for the home office, 0.2 for the office in Milwaukee, 0.3 for the office in Cleveland, etc., etc. Liabilities typically start with the number 2, either 200s in a small company or 2000s in a larger company. Stockholders' equity accounts typically start with the letter 3, 300s for small company, 3000s for a large company. You get the picture. And then revenues typically are in the fours, and expenses start with fives. So that's typically how you'd set up a chart of accounts, and then you'd use the particular accounts for the types of income, types of revenue, and the types of expenses, and the types of assets, type of liabilities that this company is expected to have. And then assets, types of assets. Short-term assets are typically cash. All types, coins, currency, bank accounts, CDs, that sort of thing. Accounts receivable, inventory, supplies, prepaid expenses, and notes receivable. These are typically short-term, except for notes receivable, which could be either short-term or long-term, or current or non-current, to be more precise. And then long-term assets are typically, the long-term note receivable, non-current portion, and then equipment, buildings, land. And we'll learn more techniques for handling specific types of assets as we go through the rest of the semester. On the liability side, you'll see short-term liabilities are typically accounts payable, unearned income, unearned revenue, and short-term notes payable. And then the long-term liabilities are long-term notes payable, mortgages, that sort of thing. And then owner's equity or stockholders' equity, typically contributed capital, retained earnings, revenues minus expenses, and less dividends. Okay, so those are the expanded accounting relationship, and you can see pictures of all the different types of assets. You've got cash, you've got land and building, you've got what looks like inventory down at the Home Depot, and then you've got some kind of machinery and equipment that looks like very high-tech stuff. So anyhow, that's it for the first two sections of Unit 3, Chapter 3, and we'll go into some more detail and the rest of the sections in the next lecture. But one thing I want to say to you is please keep current with your homework. Use the examples that are in the book as a guide to answering your homework, and then also your homework is a really cheap way to stay on there's only 5 points for 8 of the homework assignments, so it's not a lot of points, but it's the most valuable points, and it's the most valuable thing you'll learn because you're actually doing the accounting, and so it's giving you lots of opportunities to learn this by doing. And that's a whole lot better way to learn it than learning it by listening to me say it, or just reading it in the book and hoping that you remember it. So, please, get out your computers and set up Excel schedules if you need to, or get a pencil and paper and get busy with maybe copying down some of the examples if you think the material's hard. Pretty much all the examples have explanations and analysis to aid in your learning, and stay up with your homework and stay up with the quizzes. And we'll see you next time. So good luck with this, and we'll have the second part of Chapter 3 in a day or two. Thanks a lot. Bye-bye.